they have created another financial crisis, which is something I've been warning about for years. And, the media is reluctant to call this a financial crisis. They keep saying it's a banking crisis. The financial crisis of 2008 was a banking crisis. Nobody wants to say what it is because they don't want to invoke memories and comparisons to 2008. But this is a sequel to 2008. And like all sequels, this one's going to be worse.
This is where we're headed. And I don't understand why the media is being complicit. Don't they want to investigate and look into this and see the root causes and let the American people know, be ready, this is going to get bad. So at the beginning, Peter, when I said what I said, let me ask you. I've heard some other financial experts say this will be worse later this year than 2008 when these banks start collapsing. Are they being the boogeyman or are they right?
Well, of course. Well, first of all, the reason we had a financial crisis in 2008 was because from 2002 through 2005-ish, the Federal Reserve held interest rates at 1%, and that gave birth to the adjustable rate mortgages, zero doc loans, nothing down. In that era of cheap money, we inflated a housing bubble, and a lot of these real estate loans, predictably, and I predicted that, went bad when the Fed eventually normalized rates, and they got them back up around 5%, and then we had a financial crisis. But the government cut it short with QE and 0% interest rates. But now we've had 0% rates for more than a decade. The Fed has made far more monetary policy mistakes since the 2008 financial crisis than prior. And so it has inflated a much bigger credit bubble. Now the banks are in far worse shape than they were in 2008, especially the two big to fail banks that we bailed out and are now much bigger than they were back then and even more insolvent. So as a result of what the Fed has done after the 2008 financial crisis, this new financial crisis that just got started will be much worse. And my fear, which is already being validated by last week's balance sheet, is that this crisis is going to be so bad that the Fed is going to pull out the stops and print as much money as possible to bail everybody out. And then the inflation that we saw in 2021 and 2022 is just the tip of a huge iceberg, and we're going to be looking at double-digit annual inflation rates really as far as the eye can see. The banks haven't paid enough into the FDIC because they only have $100 billion. We have $18 trillion worth of deposits. And you know where that $100 billion is? It's already been loaned to the U.S. government because it's sitting in U.S. treasuries. So they'd have to sell the treasuries in order to bail out the banks. But there's not enough cash there because the banks haven't paid enough. And by the way, in 2008, the insured deposit limit was only $100,000.
Right,
it was raised to $250, but we shouldn't even have the FDIC. It was created by Roosevelt during the New Deal in the 1930s. It was an overreaction to the Great Depression. Without any government insurance, with all the bank failures during the 1930s, only about 2% of the deposits was lost. The banking system was much sounder before we had an FDIC than it is now, because back then, banks had an incentive to be responsible because their customers held them accountable. But now there is no accountability.
Because we're giving them parachutes.
Nobody does any research. Does anybody care what the banks do with their money once they're deposited? No. And even the large investors or depositors, the people that had millions and millions of dollars at Silicon Valley Bank, didn't give a crap what the bank did with their money because they were pretty sure that if anything went wrong, the government would bail them out. And lo and behold, that's exactly what happened.
We've heard there's bipartisan talks now in the House and the Senate. You got lawmakers on both sides of the aisle saying, let's raise the FDIC again above 250. I already know what you're going to say, but bad call or smart call?
No, of course it's a bad call. It's doubling down on a bad policy. It's just going to create a bigger moral hazard, but they're trying to undo the damage from the moral hazard they created by bailing out some banks and leaving the impression that others might be vulnerable. Now they've created a run on solvent banks as people rush to put their money into insolvent banks. But of course, where is the government going to get the money? If they magically insure more bank deposits, that's just another unfunded liability that has to be piled on top of a massive unfunded debt on top of the funded debt that is unpayable already. So it's all going to be inflated away. That's what people have to worry about, that everybody's bank account is at risk because inflation is going to destroy the purchasing power of your money. It doesn't matter if your bank fails because the money that you've deposited in the bank, that's going to fail. The Great Recession started in 2007, but I was doing interviews on popular shows in mid-2008, and they were saying there's no recession. So what happened was all these economists went backwards and revised down all the data, and then they said, okay, I guess we were in recession. They didn't even think a recession was coming. But the fact of the matter is we were actually in one at the time, and they couldn't even see that. And I think this is the same situation today. You know, we actually had negative quarters. The first 2 quarters were negative. The third quarter, in fact, you know, we got some numbers out on that today. I mean, it was up maybe 3% or so. But all of that was due to the improvement in the trade deficit during that quarter. And a lot of that resulted from the fact that we were able to export a lot of the oil that we were pulling out of the Strategic Petroleum Reserve. But we're going to exhaust that reserve sometime next year, so that's not going to be able to offset our trade deficits. But also, we had the big rise in the dollar. Well, in the fourth quarter, we've had a big fall in the dollar. It hasn't lost all of its gains yet, but I think it will in 2023. But as the dollar weakens, that's also going to push up our trade deficits because it increases the cost of all of our imports. So I think the help that we got in Q3 was a one-off quarter, but I think we're going to get quite a few negative prints in 2023 as more air comes out of this bubble. And then I think it's going to be very hard for the recession deniers to continue to put a positive spin on this economy. They're going to have to admit that we're in recession. The question is the Fed going to change course as a result of that admission, or is it going to continue with the rate hikes and quantitative tightening, making a bad situation worse, which is what it should do. But the question is, will it do that?
Why do you think the dollar is going to weaken? Are you assuming the Fed's going to be less hawkish?
Well, I think the real reason that the dollar rose was not just that rates rose, but that the markets believed that these rate hikes were going to work, in that they were going to bring down the inflation rate. The Fed said that we're going to return inflation to 2%, and we're going to do whatever it takes to make that happen. And the markets basically took the Fed at its word. And so they bought the dollar on the idea that, these high rates were going to produce positive real returns for dollars. But I think as the markets come to terms with reality that despite the rate hikes, inflation is not going down to 2%. In fact, it's more likely to head higher after this, brief dip that we've had. And so that even though the Fed has raised rates are still negative from a real term. And if you have negative real interest rates, that is not a incentive to hold dollars. That's an incentive to sell dollars, because the interest that you earn is not high enough to compensate you for the purchasing power that you lose. And so when investors figure this out, I think the dollar is going to fall sharply, and that's going to exacerbate the problem that the Fed is dealing with, because the strength of the dollar limited the rise in consumer prices in the United States in 2022. So even though prices were up a lot, they would have been up even more had the dollar not been strong relative to other currencies. Well, if the dollar really weakens in 2023, that's going to add additional upward pressure to already rising consumer prices.
It is kind of ironic that the dollar strengthened so much relative to other currencies while domestically inflation was at all-time highs. You would expect, inflation and the currency to be two sides of the same coin. If inflation goes high, you would expect the currency to weaken.
Well, remember, all these countries were experiencing inflation. Most of the Eurozones, their inflation rates were higher than ours. I mean, they're still looking at, over 10% year-over-year inflation rates in many European countries. So all currencies were losing value. It's just that on a relative basis, it's like if I'm going backwards at 10 miles an hour and the car next to me is going backwards at 20 miles an hour, relative to the car going backwards at 20 miles an hour, I'm moving forwards. But I'm not moving forwards. In reality, I'm still going backwards. And so even though the dollar was strengthening relative to the euro or the yen, it was still losing value in real terms. Just it was losing value more slowly than the euro or the yen. I think the difference in 2023 is we're going to lose value more rapidly. So the euro and the yen will continue to lose value, but the dollar will go from losing value slower to losing value faster. that there's a lot of inflation in the pipeline that goes back a lot more than a year. I think you got to go back and look at a lot of the money supply growth, particularly since the 2008 financial crisis. And so a lot of that inflation ended up in financial assets more so than consumer prices. And I think that we're seeing the migration of that inflation out of those financial prices into the real economy, into consumer goods. So I think it's a lot more than a year. I think we're barely catching up to inflation that we created a decade ago. So we need a much bigger contraction in the money supply than we've got, and we're not going to get it, because the problem is, before the Fed makes any real headway in shrinking its balance sheet, the economy is going to be so weak. I mean, either we're going to be in another financial crisis or on the cusp of one, that the Fed is going to reverse. And before you know it, the money supply is going to be exploding again. Except it's not going to be exploding when inflation is below 2%. It's going to be exploding when it's still well above 2%. And then that's going to help send it, up into the stratosphere.